welcome to Chapter 4 lecture. Now, due to unforeseen circumstances, I'm going to go ahead and record this lecture as long as going over it in class. So, Chapter 4, Accrual Accounting Concepts. Basically, when we look at this is helping us to start dealing with the part of the accounting cycle that's about adjustments. And this is mostly because we're going to look at basically what makes up an accounting transaction. And for accrual, there is going to be two sides. There's the cash side, where cash is eventually exchanged and objectively reflects the value of what we're doing. So, doesn't mean that you have a bill, eventually you have to pay the bill with cash, it costs you that amount of money. A lot of the basic measurement principle. And the second side that all transactions do is an economic or business side, where work is performed and better reflects the actual performance of business. So to get into this, to understand the accrual accounting methods and whatnot, we first have to know basically, again, accounting periods. And accounting periods in themselves is really, again, how can we separate the company into smaller chunks? This is that periodicity assumption or timing assumption that we have. It's actually pretty cool in the way that we go because we've already heard most of these separated out times, like quarterly, monthly, semi-annually, and annually. Again, all that ends up happening in the accounting process is that we can separate out the years and we can actually have multiple accounting cycles throughout the year, depending on how we want to end it. But this is typically the calendar year. Calendar year is being basically January to December. Not all businesses actually use this. They could use what they know as a fiscal year. And fiscal year is again 12 months, and it can be ranged from any 12 months. It can be from March, start in March, end in February. It could start in June and end in May. But it's still 12 months. It's just how do they end? Now, most fiscal years happen to be calendar. But in some organizations, such as Walmart and Gap, like Gap, but Gap is basically dying out. In fact, if you never knew about Gap, they had another branch or another big famous company called Old Navy. They actually split that off, and Old Navy's pretty much its own company now, because that one's making money while Gap is not. But for them, their fiscal year end usually ends in March, and this is mostly again because they want to capture holiday sales data and put it in their financial statements, because again, that's where they generate most of their income for a year, and that will look good for investors. They like to see. Schools are also one that doesn't end typically on December, because again, they have a school year. So typically they end in August 31st, and their fiscal year starts again in September 1st, and that's when their budgets kick in and they can spend more money. Yes, they love spending money. So, for internal purposes, again, the account periods can be shorter. Again, that's just really how the management wants. Usually for external users, we typically stay closer to a year SEC may require quarterly reports, but we keep it closer to a year. Now, when we look at these transactions, again, especially when we get into the basis, there's two other concepts to remember from previously. One is, of course, the revenue recognition, which basically means that we have to recognize revenue when we've earned it. So it's in the period which the service is performed, or when we earn the money, completed the job, or part of the job. Either way, we've earned the money. Expense recognition is, again, the matching principle, which has to match with the revenue, but it's expenses that, again, are recognized when efforts are made to generate revenue. Basically, when an expense has incurred, that coincides with generating revenue. And this basically follows this kind of cycle. Well, we take the time, periodic assumption, we apply it to revenue recognition principle and expense recognition principle, and those, again, expense has to be recognized with revenue, but they'll follow down to here, and we follow according to GAAP. Again, we've already talked about GAAP in a previous chapter. So when we look at these concepts, there is still two general approaches, or bases. One is, of course, the accrual basis, which this chapter is pretty much talking about. And this is revenue are recorded when products or services are delivered, again. And then we have cash basis, when revenues are recorded when cash is received, or expenses are paid, but basically we do not recognize any accounting economic transactions until cash has been used. And when we look at these, cash itself, I mean, it's great and all, but it doesn't give you the accurate economic. Again, if you looked up here, cash does the cash side, but it doesn't really do the economic or business side. Okay, doesn't reflect the actual performance of the company. While the accrual side, since it's recognizing when revenues earned or expenses are actually used, that one has more of a business side to it, along with that cash basis. So, of course, the best basis that's required by GAAP is going to be the accrual basis. This is the basis that we're going to be using in this class and pretty much throughout your accounting college career. Woo woo. So, of course, we got a nice little graphic to even show you how this is done. First off, it does have an activity. So in 2016, we purchased painting the building, and paid employees. But we have yet to receive the money. As you can see, in 2017, we actually received the payment for work done in 2016 from Bob's Pizza Barn. Yes, fresh colors. I actually want to know if these are actually business names now. Anyway, so as you can see on the accrual basis, since we actually performed the action, the business has earned money, we can record the revenue, which was $80,000 for the job, match it with our expenses on the job, and we generate net income of $30,000. In 2017, we do not recognize the payment because we've already recognized it when we've earned it. As you see, this is a better representation of what happened with the job. Now with the cash basis, we're recording the expense in 2016 and showing a huge net loss for the company. And then all of a sudden in 2017, when we receive the money, it's showing a big net income. This does not show an accurate representation of what happened to the business. In fact, if I'm an investor, I'll be looking at this going, what? Why would I invest with you? You lost $50K, you didn't make any money. So, again, this is just a good representation how accrual actually shows how the business is doing. Here, it's just like, whoa. And I expect you just to always generate money and no expense? There's got to be some kind of expense tied in. So, to help us out with this, right now we've been recording journal entries, and we've recorded assets, we've recorded unearned, we've even recorded some payables, so forth and so on, but all we have it is on the balance sheet, and it hasn't completed to show what actually has happened in the business. And this is the nature of accrual accounting. We must complete and show at the end of an accounting period the actual events that happened in the business. So some events are not recorded daily because it's not efficient to do so. This is the use of supplies. We're not going to do a physical count every time that actually should be cost. That kind of got me there. But, sorry. But we're not going to do a physical count as soon as somebody uses supplies. That's just not efficient enough. Because, again, that's having somebody that's constantly, every time somebody pulls something out of the supply closet, recalculate, recalculate, recalculate. Just like your GPS when you miss the turn. Doesn't work. So, at the end of the period, we're actually going to show how supplies got used. Some costs are not recorded during the accounting period because these costs expire with the passage of time rather than the result of recurring daily transactions. This is, again, business and equipment. We're going to get into those. We use them, but we don't record the cost of using them until the end of the period. Rent, prepaid rent, maybe prepaid insurance, all of those, we use up the policy. But, again, it's not efficient enough to actually do it daily. We do it at the end of the period to show how much we've used. And some items may be unrecorded. Okay. Utility bill not received until the next accounting period. Well, we know we incurred the expense. We incurred utilities. We just, again, haven't shown it yet. So we have to actually reflect that. We have to reflect us incurring that expense at times. So how do we reflect this? Well, these are called adjusting entries, which allows us to record transactions or events that have economically occurred, are basically showing how the business is running, at what time, how much is being used, everything using normal business methods. And the way that we have adjusted entries is that we usually have two general categories. One is known as deferral, and deferral is basically cash is paid or collected before the revenue or expense is recorded. And then we have accrual, which is like the opposite. Basically, cash is paid or collected after the revenue or expense is recorded. And then we can separate it into four types. which happens to fall into 2 pages. So, of course, we'll have deferred expenses, and these are cashes paid for an asset before its benefits are realized. A common item here is usually prepaids. Again, we've paid for the policy for a certain time frame, and now we're recording during that time frame how much of that policy we have basically let expire or used. Then, of course, accrued expenses is cash paid after an expense is recorded. So as you can see, these are normally assets, these are normally liabilities. And these are going to be payables because, again, we later owe this money, but we have to record the expense because the expense has actually incurred by the end of the accounting period. Then you have deferred revenue and accrued revenues. Okay, deferred revenue, cash is collected before products are sold or services are performed, which basically, again, relates to unearned revenue. While accrued revenue is cash is collected after the revenue is recorded. So this is more accounts receivable. We've performed the job and we have yet to bill our client. So we expect to collect the money later. Okay. So I'm actually going to cut this video so it's not too long for y'all right here. And we're going to go into the steps of making an adjustment and then going over each of these items as we move forward. Okay.